Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to the fifth episode of our InvesTips from the CIO's Desk series. I'm Steve Brice, Standard Chartered Bank's Global Chief Investment Officer and the host for this series. Today, I want to focus on a silent predator that tries to destroy your attempts to achieve financial freedom, namely inflation. So what is inflation and why is it important? Well, inflation is the annual rate at which prices increase. Now, the most common measures include the Consumer Price Index, the Personal Consumption Expenditure Deflator, or Producer Price Index. They measure slightly different things, but what really matters to us is that on average, prices have increased markedly over the past 90 years. This means that when you're planning for the future, you should assume that the costs of goods you will be buying in 20 to 30 years from now will be much higher than they are today. Now, not all prices go up at the same pace. For instance, hospital services and college fees have generally gone up much faster than overall inflation. Meanwhile, even some of the areas where prices have supposedly fallen, such as TVs and cars, may not have fallen as much as the data suggests, because some statistics offices quality adjust the price. Let me explain what I mean by that. So let's say a TV 10 years ago cost $400 and today it costs $1,000. Now obviously this represents a 150% increase in the cost of a TV. However, today's TV is a smart TV with a higher definition screen than the one 10 years ago. And the statistics agency tries to strip out the impact of this increased functionality or improvements. Therefore, it might say that the cost of the TV is actually the same as it was 10 years ago. But from your perspective, you may not be able to buy a new TV that is exactly like the one 10 years ago, and therefore the price that you actually have to pay when you renew your TV, replace your TV, has more than doubled. Therefore, inflation measures may underplay the increased cost of living over time. And obviously this needs to be factored into your investment plan. If you plan to have an investment pot in 30 years to fund your retirement in today's prices, you're likely to fall way short of your requirements. Now, there are two potential ways to address this. First, you can try to predict exactly what the inflation rate is likely to be on the goods you intend to consume a lot of in retirement. Now, naturally, there's many problems with this. Knowing what the inflation rate you should do is really difficult, and also you don't know exactly what you're going to buy when you're older. So a more simplistic approach is to use a rule of thumb and say, I expect inflation to be around 3% on average over the coming 30 years. It will fluctuate around that, but on average 3% may make sense. Therefore, when I look at future investment return expectations, I should subtract that 3% from the number of expected returns when projecting the growth of my portfolio. This means that you should be well prepared to achieve your financial goals. Now, just factoring in inflation can have dramatic implications for how you view different investments. For instance, a 10-year bond might offer a 5% yield, whereas equities might offer expected returns of, say, 8%. Now, these look relatively close to each other, but once you subtract 3% from those numbers, the real or after inflation return falls to 2% and 5% respectively. Now the difference, although it still only is 3% between the two numbers, the difference looks more significant because of the lower bases. And that has a significant impact when it comes to building wealth. Meanwhile, as we'll see in later episodes, a bond does not generally offer any inflation hedge, as you will be paid a fixed coupon or interest rate over the life of the bond and then get back $100 when the bond matures. And if inflation accelerates dramatically while you own the bond, the amount of goods you can buy with the proceeds from the bond will have fallen significantly. However, equities should offer a much better hedge against inflation over the long term, as returns are related to corporate earnings and profits, which should rise with inflation. Therefore, not only do equities tend to offer higher returns, they also protect you against rising prices much better than bonds, at least in the long run. So this is the starting point of why investing is important. Inflation will erode the value of the money in your bank account over time. Therefore, it's important to do something with your money to slay this predator of inflation. In the next episode, we'll talk about the concept of risk and what roles this plays in your investment journey before we start talking about how to think about shifting from saving to investing. Thanks so much for listening in today, and I look forward to catching up with you then.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.